Nice to see you again.
Here we are again.
Here we are again.
It's very early.
It's not that early. It's early to be doing this.
Cheers.
Cheers, yeah. Let's do proper cheers. There we go. Welcome to another episode of The Local, where Marcus and I get together and talk about all sorts of things crypto related. But today is slightly special in that we are going to talk explicitly about what we do as a market maker in relation to a report that we have helped produce. And the information that's come out of that was something that we wanted to independently commission and find out for a number of reasons, because we've been in the space as a crypto market maker now for a while. And the conversations and tone and
you only have to spend 2 minutes on crypto Twitter to.
Well, this is what I was worried about, because when you select who you follow and the people that follow you, you get an echo chamber of things that you like or are intrigued by or are interested in.
Yeah, the algorithms of it self-selecting.
It's self-selecting. So as certainly as I sit in crypto Twitter, I have a bunch of market making people as people I follow and likewise. And so I'm never sure as to whether the tone of "we hate market makers, they're all corrupt, manipulative, horrible people."
Wintermute dumped and my price has gone down.
Yeah, all of that. I'm never sure if that's actually a genuine, a wider crypto Twitter thing, or whether it's just the fact that my online presence is within this little echo chamber. Yeah. And so one of the things that we wanted to do off the back of like a number of conversations that we have with our token project clients and prospects that we talk to and people at conferences, we wanted to understand take the temperature of the
actually
community.
Get some hands on some hard data.
Yeah, some independently commissioned data.
We are a data business, independently commissioned data.
But we wanted to understand what the sentiment was, where it was coming from, and where the gaps were in terms of this is something that people believe, and this is the truth of the situation, and why these differences exist. So there is this report that is available. You can, we'll give you details as to how you can download it or access it. The idea is that this should be a resource that allows all sorts of different actors across the space, whether it's token projects, ideally, to become a bit more educated. Founders, but also people who back founders, like VCs who know that within their experience of having crypto companies and tokens within their portfolio, there have been instances where suboptimal outcomes have come along as a result of
multiple instances
engaging with market makers and not understanding the mechanics of deal structure, incentive alignment, and what to expect. And all of this comes in the echo chamber of people thinking that market makers are generally bad actors within the space. And so we have a new report coming out called The State of Crypto Market Making 2025, and a lot of effort has gone into it from various people. We have commissioned it as a business, but the data that's gone into it is completely independent and from surveys of over 2,000 people within the space, 98 countries I think it was that we got respondents from. And so there's a weight of verifiable information there about how people think about certain aspects of what market makers do.
And so what do you think in your idea would be the best use case for people with the report, just to upskill themselves and to get information from it so they can make better decisions?
Yes, exactly. We have conversations as a business who has an interest in engaging with token projects who like a market maker. We have reasons to be out there talking to early stage projects and projects who are already engaged with market makers and not having the best experience. And there is definitely a gap between what we think should be the understanding that people have when they go into engaging with a market maker and where the majority of prospects, clients sit. And that's understandable, right? This is not their job to be an expert on market making, right?
Exactly.
It's like, you don't expect
that's
them
why
to
you pay a lawyer, right? Because you don't know the law.
or as the space is evolving, you pay an independent third party to do this stuff for you, like someone like a Forged or a CoinWatch or a Glass Markets or someone to do this slightly technical engagement with multiple market makers.
Almost like consultancy, really.
Almost like a consultancy. So it's understandable that token projects focus on building their product and community and executing, but the wider space in general, I think, has been polluted by this idea that there's no value add from market makers, and it's always value extractive.
Yeah.
And I think there's reasons as to why that is, right? We've seen across time.
My hypothesis is that there's to get to an efficient market, you need to extract value.
Right.
That's what market making does. But
so it's taking you closer to something.
I think there's value extractive in a way that people are comfortable with, which is paying a spread.
Yeah.
Right. And then I think there's value extractive in the way that people are uncomfortable with, which is, large sell pressure
and information asymmetries.
Information asymmetries.
When people come
insider
together.
trading, wash trading. There's two different types of value extractive, I think.
Yeah. So
it's a subtle point.
And I think there's all sorts of subtlety that flows through where the trust deficit has come, and I think it's intimately entwined with the history of crypto in general, and what the industry has been trying to do as it's grown up in parallel next to a well-evolved traditional financial infrastructure. And so you have all these businesses trying to establish themselves and gain a foothold, and a lot of the incentives or mechanisms for them getting eyes on their businesses come from having metrics that are better than the next person in their space, whether that's volume or number of trades or number of active participants. And so there's all these sort of subtle incentives that might produce behaviors that are not great. And I think the core examples that I can think of that have sort of shone a light on the space, and not always in a good light, particularly in relation to market makers and exchanges as well. So I think there was a relatively well-received Bitwise report in 2019, which surmised that up to 70 or 80% of most exchange volume was based on wash trading. And whether you think it's the exchange doing that or whether they've engaged with a market maker to do that, it's quite damning. But the incentive is there.
Yeah, of course, yeah.
Right, it's an unregulated space.
Yeah.
They want to get to the top of the leaderboard in terms of volume.
Look how big our volumes are. People go and rank exchanges by volumes.
Right.
Look how much volume our token is doing. Look how many people participate.
I'm new to crypto. I want to go and trade somewhere. Where shall I go? This one's top of the rankings. The most volume's there, so I'm going to sign up and. So
even though it's illegal.
Well,
in TradFi. Right?
In TradFi, yeah. So in general, regulators hate anything that's a misrepresentation or fraud.
Of the facts,
of reality.
It's fraudulent,
Yeah.
right? You are trying to make a representation by trading against yourself.
You're trying to induce someone to do something off the back of false information.
You're trying to show that, Do you think would you like to commission a report like this in 5 years' time and see the numbers improve?
Yes, I think that's part of what we're here and trying to do as low tech, right? We're trying to improve the space.
The marketing team are just going to absolutely groan at me. Oh, I've got to do it again.
I thought this was semi-annual.
It's actually weekly, just like the podcast.
And to give you context, there's 70 odd pages of dense information that is beautifully presented in this report. Some really nice takeaways and graphics that you should dive in and see. But that's why producing it weekly or even semi-annually might be a bit tough for anyone.
Even annually, I think.
There's a lot of work that's gone into it, and a lot of care and attention, because we found this interesting as a resource for the space. There's information in there for token projects as to how they approach market makers, or how they should think about
and VCs.
How should you think
and
about
anyone who's just got an interesting trading, I think.
Actually,
it might be quite interesting for.
Despite we've touched on it in other podcast conversations, people don't really understand what market makers do. And despite us giving quite good explanations of this, I'm sure there are tons of people out there that still don't. and the idea that you can run a business that provides liquidity and it's seen as a service to either a venue or a token project is a bit different from how people think about trading firms in general, where the archetypal picture is someone taking big bets on
I think
gold is going to go up,
or I think Bitcoin's going to go down, I'm going to make a bet on that. That's not what market making does.
No, and it's all trading, right? So people just kind of lump it together and go, okay, well, how can market making be so useful to the space? But in general, I think the report will be useful as a community resource, and we will definitely do it again at some point.
Is it going to be a token
of
the report?
That's quite a good idea. Can we market make for it? One of the things we wanted to do in commissioning this report and putting out there was help token projects as they come to assess market makers, which is usually something they do as they talk about listings and getting onto exchanges. It might be that they are already listed on an exchange and then realize that the market making partner that they have or partners are not ideal, and so they might be looking to move.
Well, they might just even want to assess whether they're going to do decentralized,
centralized, which is now genuinely becoming, particularly with hyperliquid, an option. You should go to decentralized.
Particularly with some stuff that's coming out in the near future.
Yeah, it used to be that to get the eyeballs that they all care about, it was centralized listings, top exchanges, sometimes a route through a DEX initially and then onto a centralized exchange. But the landscape is changing for the better, I think. And so in the report, we've got what we think are useful sections on how to approach those conversations and key things that you should be thinking about. There's also some explanations of some of the incentives, both from the exchange perspective and how you need to think about engaging with them, because they will want a fee often if it's centralized exchange.
Quite a large one.
Well, and also if you give an exchange a large portion of your tokens as part of the fee, because you might be fiat poor or stablecoin poor, you think about how the exchange is going to monetize those, right? It's not by buying more of them.
Yeah.
Right. Okay. So think about how you manage
some
that.
OTC deals.
Right. Or just, lock up the ability of the exchange to monetize that so that it's in line with your incentives. And then there's other information which is particularly close to our hearts on deal structure in terms of explaining option plus loan, which is the dominant deal structure, or retainer, which is a monthly fee, and the mechanics around those and the incentives that they come with.
Okay, so we're going to go through some of the data, just to give an overview of the types of people. So I think we interviewed over 2,000 people.
2,000 people, yeah.
98 countries. Predominantly men, so 91% were men.
Well, we haven't seen that in the community at all, have we? Have you ever been to a crypto conference?
Yeah, exactly. Yeah, so it's a bit of a...
or tried to hire in crypto?
Oh, and just in general, trying to hire in tech, I think is quite difficult. But crypto is particularly
crypto
difficult,
is an extreme, I think.
So
very diverse geography.
Diverse geography, but unfortunately not a diverse gender sample.
What about age?
Age, most people are, I think 2/3 of people are between 25 and 44. Eesh. So,
okay,
just missed out.
Yeah. What you did?
Yeah.
Blimey, you're carrying it, at least.
And most people are, if you look at, so we asked some questions about, why are you in crypto and what do you do?
Yeah.
Most people, obviously people done multiple answers, but most people are looking to invest. Speculative, trade, yield farm.
Right.
It's mostly people trying to increase the value of their assets that they own.
But an interesting cross-section of sort of people in general in terms of geographies and reasons that they're there and what they do within crypto.
So then we started to ask some general, that's that kind of the background of the people.
Yeah.
And in general, we started to ask them questions about crypto.
What pops up to you in terms of...
So one thing I want that we could be interested to talk about is, around about just over half of people have engaged with a token that's openly engaged with a market maker. There was a secondary follow-on question about what was the outcome if they'd engaged with a market maker. And about half of people thought there'd been a pump and dump. We can talk about that separately. But what drew my eye was about half of people thought the volatility had increased. 45% of people thought the volatility had increased after the project had engaged with a market maker.
That's an interesting one.
You could think is counterintuitive.
Yeah.
And, as a seasoned options trader,
yes.
Why could you explain to people why this counterintuitive idea that volatility could increase?
Yeah, of course. I mean, there's all sorts of things that go into that. You need to know when, if the community respondents is correct in identifying an increase in volatility, you need to know when the market maker started engaging with the token, and you might well do that, particularly if the proposal from the market maker was voted on by a community through some DAO mechanism or something. Great. Let's assume that was the case. The way that crypto market making grew up in terms of fee structure, and still the way it's dominated today, is with the structure called option plus loan. And in that mechanism, which we talk about a lot in the report in terms of how it's structured and the upsides and downsides of it, because we have a bias as a business towards moving away from that model, but we can see that there are reasons as to why it's useful, both for the market maker and potentially for the community as well.
Just to point, what's the other major deal structure is a bit more of what
a retainer or just like a service fee.
A service fee. So a bit more classically what people would expect. You're paying for a service, you just pay a monthly fee.
Right.
Right, exactly. So a bit cleaner, but has downsides for...
Has got like upsides and downsides
it's got upsides and downsides. Yep. For, we prefer to do a retainer deals.
Yeah, just more in line with how business-to-business relationships normally work in terms of paying for what we believe to be a service.
But it does have a downside that you are required to front up fiat on a monthly basis, which a lot of tokens might not have.
Exactly.
They're token rich and fiat poor.
Token rich, fiat poor, which is certainly the environment in which this fee model grew up in.
The option plus loan.
Option plus loan.
And so why did it grow up like that?
So if you think about ICO periods, 2017, white papers getting you funded, or white papers being able to, the precursor to doing a token launch, often these projects were very token rich. Or going to be very token rich in terms of number of tokens, not necessarily like monetary, like dollar rich, but
because you can create them out of anything. I've got a billion tokens now.
You've got some smart contract experience. Yeah, exactly. You create them with some code. Great. And so you have this pseudo asset, all these tokens, but you might not have any fiat to be able to pay a market maker. So what you can do is you can write then a derivative, a contract, because that's all derivatives are. They're contracts. They're not physical assets. So it's literally a set of legal agreements that you and I or anyone else can agree to.
It's all just paper.
It's all just paper and lawyers. And so in that situation, 2017-ish, to get listed, often exchanges would say, who is your market maker? And token projects would go, well, we don't have one this work. And we can engage with a market maker. And the market maker say, well, we're happy to do this.
How are you going to pay me? Because this is not a charity.
The salesperson wouldn't be that crass. But at some point they would go, we need to be remunerated for this. And so with no fiat there to pay them, another structure came out of that situation, and it was, okay, the token will write an option, or will give an option to the market maker, and in market making in general, the token project needs to give assets to the market maker, particularly the token, so that you can sell the asset, but also buy
that's
it.
The loan portion. That's the loan portion's absolutely standard in all deal structures, basically.
Yeah,
you need to be loaned the token to be able to market make.
So if you want to become a market trader that both buys and sells the thing that you're selling, like if you're selling mops, you need to have some mops there. And
so the mop provider might loan you some mops.
Loan you some mops.
I'm going to loan you some mops so you can start selling them for me. Yeah.
So the way that the market maker in that situation gets compensated is they get given the loan anyway, because that's default. You have to have the loan, but they get given the right to buy those assets at some point. And that's an option. That's an option. Yeah. The right to buy at some point in the future for a certain price.
And why is there it could be a perverse incentive that a salesperson might be able to pitch that would incentivize them and align them.
Oh, now you're getting into some of the other things we touched on in the report. It's
sorry,
like, it's fine. It's fine. Like,
I want to talk about volatility increasing.
Yeah. Okay. So we'll come back to that piece in terms of what that option might mean in terms of the way it's pitched to you, but in terms of the mechanics. If you give an option to someone, particularly if you give an option to someone, they are long the volatility of your asset. What that means, they're long. So it means that the value of the thing that you've given them, the option contract, goes up when the volatility, now I'm purposely blurring implied and realized volatility, but when the volatility of your underlying increases, that contract that you've given them goes up in, let's say, dollar terms.
Yeah, because it's got more probability of being in the money.
It's got more probability of being in the money. And so when you engage with the market maker in this way, certainly when the token projects engage with the market maker in this way, you are giving to your service provider a means of paying them. You've paid them, you've remunerated them with this thing that has dollar value. And that thing can go up in value the more volatile your token price is. And so it's really interesting to see that in the report, that the community believes that when their tokens engage with a market maker, they subsequently see volatility increase.
Which is, of course, exactly what you would expect.
Yeah.
Because the market maker is incentivized, because you've given them an option, which means that they're long vol.
Right.
Means that they're going to make more money.
More money if it's volatile.
If it's volatile.
Now, the piece that's not known and shouldn't be the case is that they can cause that volatility.
Yes.
Right. They should benefit from it because they have a contract which will go up in value as volatility increases.
Well, the implication is that we signed with the market maker. The outcome was volatility increased.
Well, pump and dump as well. So
yeah.
You're seeing two things. That
I don't
kind
like
of,
the phrase pump and dump. I mean, like what over what time scale?
Right, and how do you identify it?
And I identify it. I think that answer demonstrates a little bit of maybe anger in the community, a bit about how maybe some of their investments post market maker has gone,
and reflection of rumours and third hand suppositions about, in certain cases, how token projects might be monetizing their treasury early through engaging with the market maker, and how a market maker who, in a lot of cases, particularly under the option plus loan model, through the loan might end up controlling a large portion of the floating,
which we've seen.
Yeah, and so when you have one entity who is a trading firm who holds a large portion of the float of a token, it's easy steps to go and go, this person is moving the coin around.
Yeah. And which we know people are doing as well.
And then you put in this incentive that they've actually got this asset, this option, where they also benefit if this thing moves around a lot. Then it's not many more logical steps to go, hang on a sec, I've engaged with someone who can control the price movement or has the ability to control the price movement. They benefit through this asset, this derivative that we've given them for increased price movements. Ergo, when I see increased price movement, I believe it's the market maker that's doing this.
Which is why I do think one of the benefits of a retainer deal is that there's no incentive for the market maker to have higher volatility on how you've paid them.
Or price direction.
Yeah, or price direction.
I mean, other than the second order effect, if you want your project to flourish, and that usually is manifested in increasing pricing. From a retainer perspective, they're providing liquidity on either side of the order book, but you don't benefit either from volatility or from price direction of the So there is a subtle shield for retainer base. But that's fascinating that many respondents believe that vol increases.
It's that's come out and people who we basically retail traders who make up the majority of the survey respondents. I don't know if there was a question about if they were professional investors or not. But
there's a few, and you see it in the stats around what you do. I mean, but the vast majority believe themselves to be traders and investors.
Yeah, but there is a subtlety to understand about how paying a market maker with an option can lead to increased volatility that comes out in the survey.
Yeah,
it's very interesting.
Yeah, interesting one.
So one of the questions is, could you explain crypto market making to a friend without Googling it first?
Okay.
And basically,
is that actually what you're asking me?
You don't have any friends.
So can't use Google.
So basically 90% of 50% of people said yes.
Okay.
And another 40% of people, 38% of people said, I'd give it a shot.
Okay, so this is good.
90% of people reckon
they know.
Back themselves on what market makers do.
Okay, I'm happy about that. That's good.
Yeah, and then there's another question about what do you think crypto market makers do, which has a lot of different options.
So the first question is qualifying question. Do you know what they do?
Yeah.
90% do. I'll give it a shot.
Yeah. And then what do you think crypto market makers do? Do you think the answers to this question give away some overconfidence in the previous question?
I just think they give away some interesting views on how the space thinks about market makers. Okay, so what's the top answer there?
The top answer is the right answer.
Okay.
But it's only 60% of respondents.
But that's good. I mean, that's a good thing.
Well, because 90% said that.
Okay.
So what happened to the 30%?
The 30%. Right. Yeah. Maybe they're the ones who are making loud noises about what the second answer is.
Yeah. So the first answer I think is correct. 60% is provide order book liquidity.
Okay.
And that is categorically...
They're in their actionable liquidity in the order books.
Completely. 60% of people... Yeah. Correct.
Well done. Ting.
56% of people said that it's generate volume.
That's a problem.
That is a problem. Why is that a problem?
It's a problem for a number of reasons, and it's something we bump into a lot. You know, I've tweeted about it. Like the number of people that we speak to at conferences,
and the number of times, so I'm sitting in the office, doing all the engineering kind of things and Tim's on the sales side of the room pitching. The number of times that I've had to have you say, "We won't generate volume."
We won't generate volume.
It's in the tens.
If
deep tens.
If you heard me say this, what are the reasons that you think I would give as to why we don't generate volume, or why this is not something that a market maker should be responsible for?
Your answer would be it gives a false impression.
Yeah. exactly.
And I agree with you.
That would be the SEC's problem with it, and the FCA's problem with it as well.
Yeah. Any reputable jurisdiction would have a problem with that.
Problem is exchanges don't have as much, or crypto exchanges don't have as much of a problem with it. Why don't they have as much of a problem with it?
Because they're incentivized to have it. They get paid on fees.
Because they get to the top of the rankings based on fees and volume. And
my exchange is in somewhere where I can't be extradited to the US or something like that.
But the impression is amongst the community clearly, okay, order book liquidity, good, well done. That's core to what a market maker does. Mm-hmm. But then, as you say, 56% of them saying that we are there to generate volume. That's a problem.
Well, yes, over half of people want us to engage in what I would call crime.
Wash trading.
Yeah, it's wash trading.
It's wash trading.
But I would think of it as a crime.
And so why is that important? Why is why is volume important to token projects?
I think volume is important because, well, it depends on the project, but some projects might even have a transaction fee. So they could even be monetarily benefit from people swapping,
particularly on the DeFi side.
On the DeFi side, yeah. It gives an impression that your token is active, large.
Yeah,
you've
big
got
community behind it. Loads of people trading it.
It
gets picked up by all these AI bots on Twitter.
It's like it's something to be excited about. It's basically the equivalent of being popular, isn't it?
Yeah, and certainly in the olden days.
2022?
Yeah, exactly. No, probably before that, we used to have tokens looking to get listed on exchanges, right? Great, and we know that that's something that has been an evolving process. But you would have exchanges specifying minimum volume numbers in those listing requirements. So a token project would go, okay, great, I've got listed on XYZ exchange. That's not really an exchange, is it?
XYZ.
XYZ exchange. And I've paid my listing fee, or I've given away a percentage of my tokens to the exchange, which comes with other problems, which we talk about in the report.
There's a reasonable thing that I do think. I think it's almost like reasonable for the exchanges to say we need a minimum amount of trading to occur, because exchanges don't want a graveyard of failed projects.
No,
chalking up the things.
Fair.
But they just need to have a qualifier.
Yep.
We need 50, or whatever it's going to be, a minimum $50,000 minimum of naturally occurring volume.
Yeah.
And just
then enforce
the exchanges know.
But exactly. So in traditional finance, right, the exchanges are the first. They're in the front line of enforcing the market manipulation rules and making sure that this doesn't occur on their venue. Whereas we haven't evolved as far as that in crypto yet, and hopefully it will at some point. But
so Coinbase must be I can't actually remember what the self-trade prevention. I don't think you can. I think you can.
It's auto in there already.
Auto on, I think. Yeah. I can't remember.
But you can see you're completely correct. You've identified why the exchanges care about there being volume. The problem is that when they contract with the token to guarantee, like the token guarantees that there's going to be volume as part of their listing agreement, and then the token turns around and goes, I've got no idea how to do this, and I'm not going to sit there every day and trade the $50,000 that I need to trade because I'm building my token project. Okay, and then they've got a market maker in their ear whispering, going, we can do this for you. Or a bad acting market maker in their ear going, we can do this for you. And so therefore they engage with someone who's provided a solution to their problem, and job done. And so suddenly you have all this wash trading activity that's out there in the space.
Like, the way I view it, it's like misincentivizing. It's like misincentivized at like three different steps.
So many different steps.
And so it kind of has this multiplicative effect.
Yes.
Where the exchanges are incentivized to have it, and then
therefore it knocks onto the token. And the token kind of subtly wants it both to keep their exchange happy. But also because
of like how the looks and marketing and then the community, the market makers, want. Some market makers will do it as well, right? Because they'll get paid for a service.
Exactly. So they can offer it because technically it's possible on a lot of different venues if you don't set yourself up right, or if you don't care. And they're incentivized to offer it because it means they win more deals off the tokens out there that want it to happen. So the incentives are all sorts of wrong in this area. And it bleeds through to the community by them going...
so that number is one I'd like to see go down.
Yeah, for sure.
Is there anything else in...
Yes, 37% believe that crypto market makers coordinate.
So coordinate is quite an interesting word. They coordinate price manipulation.
So acting across different firms to...
between
token and...
Token and themselves.
Yeah.
We're going to make it go up 10% over the next. I mean,
Right.
I have, naming no names.
Yep.
And maybe before I was publicly on the podcast, I have been pitched a market maker. In fact, you were there as well. We've been pitched.
Belgium, 2024.
Yeah, ETHCC. Yeah.
Yeah.
We've been pitched by a market maker who just assumed we had a token. We
Someone-
didn't even talk about.
Might be a spicy take. Someone we would consider, in the broadest scheme, a competitor of ours in terms of we end up pitching to the same projects.
Yeah. Oh yeah. I wouldn't think they're definitely not a good actor in the space.
Definitely someone we see when we go to conferences.
Yes.
Yeah.
Anyway, but we were fully pitched by a chap.
When to be clear, they didn't realise that we were in the market making business, or that was part of what we do.
Well,
at
we
Low
just
Tech.
stood around having a beer, talking.
Yeah.
Sales guy comes up, t-shirt on. Oh yeah, what do you guys do? And we asked him, tell me about it a little bit. And he was like, the thing what I'll do for your token is we can say, we're going to put it up 10% on the first day, then we'll bring it down 5%. It was like fully like, I mean, you had jaws on the floor.
Absolutely. Quick, get my phone out.
I was like, can you just say that again? Record it.
It's remarkable, right?
Yeah.
And the brazenness of it is remarkable. And I'm conscious that I come from a traditional finance background where I had to do.
It was at least done in a brown envelope at the back of the pub.
FCA regs were something you had to do every year to make sure that you were aware that this sort of stuff was it was not allowed.
Yeah.
And you got people pitching this to you like something that is their core part of their business.
Yeah.
Okay, maybe they are domiciled in an area that doesn't care about it. Maybe they're operating on exchanges that don't care about it.
Right, probably, yeah.
But still, I mean, this is not where we as a business think the direction of travel within crypto is going anyway. And so we're structured to
exactly
internally avoid all of this sort of stuff.
We could look at that favourably and say at least 2/3 of people, so over a majority, don't think we coordinate price manipulation.
Okay.
So there is it does.
And then so there's also pump prices, and dump tokens. I mean, this is something you wanted to mention in terms of pump and dump. It's how would the community know? Well,
it's a pump when pump when you make money, and it's investing when you make money off it. It's a pump and dump when you lose,
yes,
right?
Okay.
I mean, I just, of course, there are pump and dump groups on Telegram, and we've all seen them where they try to coordinate buys and then sells and all this kind of nefarious shit. And I guess you could talk about that price manipulation could be viewed as pumping and dumping, because certainly, like when we were pitched by nefarious market maker. They were talking about we'll move X%, we'll move it Y%.
Yeah.
So maybe that pump and dump, maybe it's the same as manipulation. But I don't
price management as a service.
Price management as a service, yeah. But I don't particularly like the phrase pump and dump because over what time phrase? When BTC went from 69 to 19.
And how do you know that price move up, that green candle was not a whale in your community just like aping in as opposed to
exactly. So
an unidentifiable market maker?
I find the whole pump dump to be a bit of a low IQ response.
Okay.
Sorry guys.
Sorry guys. So we've identified that there's a false impression between what a good market maker should do and what the community believes that they do, even if they're good or bad, and particularly in generating volume and coordinated price manipulation. That's kind of interesting. Some of this and other actions have led to what we believe to be a big trust deficit. And you see this coming out in our little echo chamber of crypto Twitter. And that's reflected in some more of the data from the report as well. So trust-wise, we asked, do you trust crypto market makers? And the response is kind of interesting. Up at 42% of saying
not really.
Not really.
So I think, so the majority, if you add not really and no.
Yeah, not really and no.
You get 60% basically. So over, a majority of people do not trust us really.
Yeah, and do you think that's evidence-based or do you think it's sort of echo chamber of Twitter? Or...
Absolutely evidence-based.
Yeah. Me too.
I don't trust some crypto market makers. Which leads me to the other question, right?
Yeah.
As well, which what's it about? If crypto market makers could go on trial,
have you got your lawyers here?
Would you prosecute? Yes.
70% of respondents said if crypto market makers would put on trial, or do you think they should be put on trial for what they do? 70% said yes.
Well, it depends. There's a subtlety to it.
Yeah.
I think some crypto market makers and some crypto markets have been
charged. Yeah.
I don't know the actual ins and outs of it, but yeah, basically, I actually agree with that.
Yeah,
because I think more
it helps
clean
up the space. But as a byproduct,
and I completely agree with the do you trust crypto market makers? I think I would respond not really to that question as well.
Yeah, because I mean, and we're coming from very much an evidence-based approach to that. We've seen.
I mean, we have recently looked at data.
Yeah.
Where we have identified market makers doing wash trading. And we have literally got verifiable.
Proof. Yeah. We've been pitched price management services. Yeah. We've got data that shows that wash trading has gone on. And we're not the only ones here. As I said before, Bitwise produced a report 5 years ago that identified all this wash trading that was going on, and they used exchange data to prove this as well.
So I completely agree. I think it's evidence-based. I think the respondents in that to those questions are correct. And I agree with prosecute as well. Though you don't, I don't think.
Well, I wouldn't want us to be prosecuted because I think we act in a very good way. So when you lump everyone in as market makers.
Don't engage in crime, though. Do I think people who steal phones should be prosecuted?
Yes. Yeah, exactly. Which leads on to some of the other questions that we touched on in the report. And please, find it, download it, read it, digest it.
So
and then,
there is a question about. What would make you to address this trust deficit?
How do we get past this?
How do we get past the trust deficit? What would you make you trust a crypto market maker more? And the top answer is transparency about data, basically, isn't it?
Transparency about activity and fees.
And so
like deal structures. In a space that's built on verifiable open peer-to-peer transaction technology, which the whole idea was that you could see this stuff on a public blockchain. And we've come so far in terms of the various different evolutions of particularly where trading and exchanges of value happen. But you would hope that transparency is the response. There's some other interesting things, and they're publicly declaring deal terms. I don't know.
Well, you kind of do with the DAO if you're dealing with the
DAOs. Yeah, exactly. And Evgeny's talked about this. I saw him talk about it on stage in Evgeny, the CEO of Wintermute. He's said, look, we would, if others did, as in we would put this stuff out there.
You show me mine, I'll show you yours.
Exactly. Yeah. Just the sort of thing you say to me all the time. And then there are others. We were having a chat with Keyrock the other day. They're working to produce sort of ISDA-based documentation which puts standardized templates around this sort of stuff. So there are moves happening that kind of fall under that transparency umbrella. And hopefully that will improve both some of this trust deficit, which we've identified through the report, and also some of the understandable lack of understanding, which is out there in the space.
I think 10% of people never
going to trust a market maker.
Never.
Fair.
So the best, we've got a ceiling on the best that we can get.
90%.
90%.
Okay, I'd take that. I'd take it as an improvement from where we are. There are some final considerations that we should run through here, which I think are useful. Understanding how anyone is compensated when you engage with them from business to business relationship is important.
Oh, right? Strongly consider if you want to give away what is essentially equity in your project.
Yeah, or exposure to equity. Or exposure to token.
I'd think about that quite carefully. I think that would be, when you get into deal structure, that's something that I would be thinking about quite keenly.
Yeah.
And I understand, get it, if we will do an option plus loan deal if
a project
really insists because they really don't have any fiat.
And we'll also explain how we're going to monetize that as well, which is the piece that doesn't often happen. But yes, think about when you're engaging with a service provider.
Yeah, how you remunerate them.
Why are they asking for an OTC structured product as a way to be paid? I mean, it's an odd way to pay for something. Even if you don't have cash, it's still quite an odd way to pay for something.
Yeah.
Think about how you, once you landed on a deal structure, think about how you make it enforceable and what performance looks like.
Yeah, KPIs.
Right?
Yeah.
You've engaged with them for the service. Like if our AWS service isn't hitting, the expectations of what they've advertised it as being, or it's not doing what it's supposed to.
They're going to compensate.
They're going to compensate.
I think actually I'd say to token founders now, I just wouldn't put up with shonky reporting for KPIs.
I think reporting, no. The shouldn't exist.
The space has moved on enough that you should really, and you can get one from us, but you can get them from other people as well, but you should be asking for a real-time dashboard.
Real-time dashboard, real-time measurement versus the KPIs that you've agreed in your deal, not just some generic metrics that might be industry standard.
No AWS logs.
No AWS logs, no PDFs. The piece that we're alluding to here is that if you're going to do modern market making, whether it's prop market making or token market making, you need to be of a level of like sophistication technologically wise
that you can provide all your data in real time.
That you should be able to provide a dashboard in real time.
Yeah.
And if you can't, then that's a question to ask. Like, do I want to engage with someone who can't do this from a technology perspective?
There's either two things. Yeah, if they can't do it from a technology perspective, that's a question mark.
It's a red flag. Yeah.
And if they can't because they don't want to,
it's different. Yeah, then you have to question why don't they want you to see what's going on? So,
but that goes actually to the next consideration: can I monitor performance in real time? Which is are the legal entities operating in? Are their legal entities and operating jurisdictions clear?
Yeah. I mean, important, certainly when you engage with areas of the world which are more or less friendly towards crypto in particular, but also if you get to the point where you're having to think about that sort of stuff, it's usually because something's gone wrong. So you want it to be in a jurisdiction where you feel that the rule of law is going to be applicable, and the contract that you've signed with this entity is going to be enforced in the way that you believe it should be. So all those sorts of things are important. And then verify. Right, if they're a decent market maker, they'll have other projects
that can attest.
Yeah, and you should ask them for a
special guest to fly.
Special guest
if you can see that.
you should ask them for a list of references and go through those references. Do the little bit of research to find out the goods and bads of this potential partner of yours, because in early stage projects, market makers can have hopefully a very good impact in terms of providing good actionable liquidity into the order book. But if you're compensating them through option plus loan, they can hold an outsized portion of your supply at a very crucial time as well. And so you want to make sure that other projects that have been through these steps with this partner have good things to say about them.
So I think we've talked a little bit about the data, but if you want to actually look at the data yourselves, what do you have to do?
Go and download the report. It's available on the Low Tech website. It's low.tech/state of market making. If you're listening to this, you'll almost have certainly seen us putting the report out there.
If you've listened to this, you've probably already downloaded it, but you should download it.
Yeah. So great. Any questions about what comes out of the report, please fire them our way. We'd love feedback. What is not there, we'd love to know about. It's pretty extensive. It's great, I think, for early stage token projects. It's great for VCs because then you can ask your tokens to be asking these questions. And I think
it's a bit of a checklist, really.
Checklist. And there's enough out there for the community in general to hopefully try and improve the opinion and understanding of what market makers do. So download it.